Hi, everyone. Welcome to today's Cannabusiness talk. Am I trafficking? My name is Allison Kirchhofer. I am a cannabis CPA, which means I have specialized knowledge and training to help cannabis businesses with all sorts of accounting concerns and issues. And today we're discussing takeaways from the Champ case, which dates back to 2007 and it is still the guidance that we refer to when it comes to allocating expenses that are otherwise non-deductible to THC companies under a non-canna division. And there are a lot of important considerations for businesses. This applies primarily to retail establishments and delivery companies. So the Champ case, Champ stands for Californians Helping to Alleviate Medical Problems. This is a business that was based out of San Francisco, and they mainly provided caregiving services to members of the community that that suffered from AIDS, and they also dispensed medical marijuana to their members. So the two key takeaways from this case are that it provided a definition of the term trafficking, which is an important one in the Internal Revenue Code 280E. And just very quickly, 280E is the code that says that THC businesses, and I use the phrase THC to distinguish from hemp and CBD because those are not listed as a controlled substance on Schedule 1 or Schedule 2. So 280E does not apply to those, but 280E does apply to THC and says that businesses that traffic Schedule 1 or Schedule 2 substances cannot take ordinary and necessary business deductions. So the Champ case provides a definition of trafficking that is really important. And it also introduces the second line of business argument. So often there's talk of allocating expenses to a non-canna division, and this is where that comes from. So the Champ case basically focuses on the commercial transaction piece of trafficking, essentially buying and selling cannabis. So what is unclear here, and this is a really important takeaway for anybody that is in the delivery business or thinking about getting into the delivery business, is whether the actual transport of cannabis is considered trafficking. So that's a gray area, and it's something that you have to consider strongly when you're building out your business plan for delivery services. There was a recent case actually in Kansas where the police seized lots of cash. So we're not talking about the product itself, but the cash was going across state lines. So that's happened very recently in the news. So the transport of THC is not defined here. In the Champ case, the definition focuses on buying and selling regularly. The other piece of the Champ case is the second line of business argument. So Champ itself was determined to have operated with a dual purpose: the caregiving services and the dispensing of medical marijuana. So the court did acknowledge that a company can have multiple lines of businesses, including a THC company. So the big takeaway here is that a separate trade or business or a dual purpose depends on the economic interrelationship of the activities, not the entity structure. So the IRS does not care if you've got 12 S Corps and 2 LLCs set up. What they're concerned with is looking at the overall interrelationship of the business activities. So I have here a checklist of some considerations to keep in mind. So first of all, are they substantially different activities? And is the business regularly and extensively involved in both activities, or is one simply incidental to the primary activity? And is the income derived mainly from THC related matters? My further thoughts are these last 2 points here. Can the activities be marketed as distinct strategic business units? Can the activities be budgeted separately? Are they distinct profit centers? If the answer is yes to these questions, then you may be able to argue that you have a dual purpose. So in conclusion, if it's determined that a second line of business does exist, then it better be substantial and profitable. And a portion of expenses can then be allocated as long as it is done reasonably and consistently. In the Champ case, it was allocated, expenses were allocated based on a labor and square footage that was devoted to each distinct line of business. In general, the IRS, when they're coming in to audit a business, they look at the entity and business structure whose sole purpose is to evade taxes. If that's the determination, then you're going to have an unfavorable audit decision. So I suggest that if you are in particular in the delivery or considering being in the delivery line of business or retail for cannabis, bake in a legitimate second line of business to your core business plan. And then allocate your expenses with a defined driver, such as labor or square footage, and do it consistently and document it so that when the IRS knocks on your door, you can answer it confidently with this record of how you're allocating expenses and why. So that's it. Thanks so much for listening. I hope that you found this information valuable. If you did, please reach out. I'd love to hear from you. And again, please spread that internet karma with a like and subscribe. Thanks so much.